Well, tax season is upon us, and there are some important things that you need to know about before you file this year. So just as a friendly reminder, the due date for most Americans is April 15th, but you can file for an extension. So if you do, the tax return will be due on October 15th. Now, almost a third of Americans wait until the last minute to file, but there are benefits to filing early. You're less likely to make mistakes if you aren't rushing, and you'll get your refund faster, which is always a good thing to hear. So we're breaking down what you need to know before you file. Joining me now is CPA Donny Burkett with some tips. Donny, thank you so much for stopping by this morning.
Appreciate being here. Last thing you forgot to say, it makes it easier on your tax preparer if you do it early too.
Yes, yes.
Those last minute people kind of drive us crazy. So that's good.
Coming from the CPA,
that's
you know.
Right.
All right, let's go ahead and talk about those 4 itemized deductions that many people might forget about.
Well, the main itemized deductions you get are your medical and dental expenses, all those you combine it. It's got to exceed a certain amount of your income to take it, but that's one of the deductions. We tell people to keep track of all your medical, dental, and expenses, and insurance and those type of things. Keep track of, you get a statement on your home mortgage deduction, so make sure you get your home mortgage statement. And on that, it'll not only have your interest expense for the year, it'll have the main amount of property taxes you pay. So you get to deduct taxes, which would be property taxes, cars, houses, as well as some of your state income taxes. And then the other thing mainly is charitable donations. You get to deduct your charitable donations. And with those, just make sure you get a receipt from the person you gave the donation to, because you need that before you file your tax return. And those are the itemized deductions you get to take. So those are the things, just keep track of those as the year goes by. You know, keep a file, put the things in it, end of the year, add them up and give them to your accountant.
So let's talk about those charitable contribution tips.
Yeah, okay, the charitable contribution tips we do for a lot of people would be a couple of things. Number one is if you have appreciated property such as stocks and things, you can give that to a charity. And number one is you won't pay tax on the gain if you have a $5,000 basis and it's worth $10,000. You don't pay tax on that gain, but you get the entire $10,000 as a deduction.
Yeah, there you go. So
you save tax by getting a deduction, and you also save tax by not paying taxes. So we do a lot of donated property to people to do that. People do that, donated property, and mainly stocks. Sometimes there's other things, but you have to get appraisal. So keep track of that, but look at it. If you've got with the stock market going up this past year, you may have some appreciated stocks you can give away. The other thing from a donation standpoint is we try to do what we call bunch donations, and for example, with the itemized deductions, you roughly get, as a married person, you roughly get $28,000 if they add up less than that, the government still gives you that. But if you're giving $10,000 a year of charitable contributions and your other deductions add up about 28 that year, if you go ahead and prepay the next year, you can take that $10,000 deduction by bunching the contributions in one year.
Put it all together.
All together. Instead of doing one year and one the next year, bunch it together.
Why not?
And if you're in the 30% tax bracket, that saves you $3,000. so it's worth doing. So we look at that with people. You know, sometimes it's just better to give a charitable contribution. Also, we have people who have retirement accounts, and you have to take a qualified retirement deduction for that income out of that every year. And you can give that as a charitable contribution directly to the charity if it qualifies, and you don't pay tax on getting that money out. So if I'm required to take out $10,000 and I want to give it to a charity, I get the $10,000 out of my retirement account, don't pay tax on it, and the charity gets the money. So we do a lot of that with people who have retirement IRAs that you have to take a qualified distribution out of it. So we do that. That saves money from that standpoint.
And really quickly, South Carolina has a couple of specific ones.
Yeah, South Carolina had a couple of things that we always tell people. Number one is if you have an active trade of business where you have people who work for you, the maximum tax rate in South Carolina is 7%.
Okay.
But for the active trade of business income, it's only 3%. So that's something that we look at, and you can do it at a partnership level or the individual level, but you have to look at and decide what's active trade and what's not. Because I don't know who you are. If it's less than half the tax on something, that's a lot of money, right?
There. That's a lot of money right over there.
And two things is, we find this too, you get a 1099. You know, if my spouse passed away and over 65 years old, and I'm getting their retirement as well as mine, you can take a $10,000 deduction for that spousal retirement account.
Yeah, okay. I mean, you have all of those tips over there. The good thing is we put that up there on the screen, and we're also going to put this whole interview on our website. Donny, thank you so much for stopping by this morning.
Thank you for letting me be here.
He comes in with these tips always.